All right. Hello, everybody. Thanks for checking in. Stock market jobber. All right. So I've been talking about how we're going to have a reversal, and I think it's started. I'm not here to pat myself on the back or anything like that, but I just think the reversal has started, and let me show you why. And if you follow us, you know I've been talking about the same things for the last week or two. One of the things I've been talking about is that we got this really bullish sentiment. Now it's kind of fallen off. We got the new reading out, but this is a site that we look at as Stock Market Jobber. It's free. It's a great site. You can get a lot of information from this if you're interested in the markets. And it's an association. Is it an association? Yeah, association of individual investors. I'm not a member, but there are people that are members of this, and they ask, "Are you bullish, bearish, or neutral?" Now, if we have if we have an excessive amount of investors that are bullish, or if the overwhelming group of investors are bullish, that's actually bad for the market. Now, I know that sounds counterintuitive, but there's a logical reason for it. If the vast majority of investors are bullish, what do? They invest their available funds. Okay. When they're done investing their available funds, what happens? The market runs out of buyers. And when the market runs out of buyers, the only place it can go is lower. So excessive bullish sentiment is bad. When everyone is talking about, I bought this stock, I bought that stock, you go to a cocktail party, you go to I don't know, a wedding or whatever of a relative, and people are talking about the stock market, people that don't really typically invest in the stock market, that's a warning sign. That's time to sell. So we have had this big amount of bullishness. We've only gotten above 50% a handful of times over the last 20 or 30 years. I mean, this is an extreme reading. All right. So, in addition to that, there's been this narrative that, okay, well, Powell's going to come out and he's going to speak and they're going to say all the interest rate hikes are over. And that's completely asinine and stupid. I don't know why anyone would even think that. I mean, I mean, Powell's pretty damn incompetent. Okay, he really is. Um, wow, look at that. That's some pretty darn negative action. So, Powell's always been wrong. But anyway, people have been like, all right, well, they're going to stop raising interest rates. That's going to be good for the market. Higher interest rates are bad for the market. And there's a couple of reasons why. One is that if you have higher interest rates, well, the stock market has competition. People might say, well, all right, well, I'm going to invest in the stock market, or I can go into the bond market and get 6 or 7% guaranteed. The other thing is that when we have higher interest rates, companies um, lose money because companies don't take money out of the cash register to pay uh, their expenses, right? They borrow money. They have these overnight or short term agreements with banks. And if interest rates go higher, guess what? It costs more for them to borrow money. So it's right out of the bottom line. The third reason is that there are funds that use a lot of leverage, and leverage is really just borrowed money. So the higher interest rates go, the less leverage people will get. So interest rates are higher are not good for the market. And if you follow me, I've been saying this for a while. There's this narrative going around. There's plenty of false narratives on Wall Street, and that's why we can make money. All right. So anyway, so here's the S&P 500. We follow this ETF. This is a really negative action here. Okay. This is what we would call in the candlestick world a bearish engulfing pattern. Okay. In the Western, I get them confused. Okay, so that's the Eastern world. In the Western world, we would call this an outside reversal day. Think about this. Today, this morning, it looked like it was going to be another bullish day. The blue candles are days that we were up. The red candle are where the close was higher than the open. The red days are days where the close is lower than the open. So we got the blue team in charge. It looked like the blue team was going to be winning again today. Guess what? By the end of the day, we had completely reversed. And the red team or the bears pushed us all the way back down. The reason why it's called an engulfing pattern is because the action engulfs all of the action from yesterday. Here's yesterday's high, here's yesterday's low, here's today's open, and today's close. So we've completely engulfed it. Sometimes, well, as traders, what we're always looking for is the trend to reverse. Markets are either going up, down, or sideways. Okay. When markets are going up, the bulls are in charge. When markets are going down, the bears are in charge. When there's a slow change of leadership from bulls to bears, that tends to show up on a chart as something that looks like a little bit of like a rounded top or a rounded bottom. It's a slow change. When we have a change of leadership that happens over the course of a few days or maybe a week, that shows up on a chart as maybe what we call a V pattern. Right? Patterns are not mysterious or astrology or tea leaves. If viewed correctly, what they are is just a graphical illustration of what's going on. Now, sometimes we have a change that takes place in a single day, and we call that a reversal day. And there's a really good chance that that's what happened today. So since about a month ago, the blue team has been in charge. This morning it looked like the blue team was in charge. By the end of the day, the Bears or the red team came and pushed us all the way down. So we have been focusing on the financials, and we have been focusing on technology, and we have been focusing on healthcare. So here's our financial sector. And what I'm looking at here is an ETF, XLF, which tracks the financial sector. We got really overbought. We got to a level that was resistance. Markets that are overbought that get to resistance tend to sell off. And it looks like that's what's going on here. Why is there resistance around this level, around 35.30? Well, it was support. People bought back here, and when the market went lower, a lot of these people regret buying, and they tell themselves, man, if this ever gets back up to my price, I'm out. I'm getting out at break even. So we got remorseful buyers placing sell orders. And if there's enough, the level that was support converts into resistance. And so it looks like that's what happened here. All right. So now let's look at our technology sector. Different sectors run the market at different times. There's 11 sectors in the S&P 500. And here at Stock Market Jobber, what we do is we look at these sectors because now I spent more time than I care to remember because it makes me feel old in the institutional trading world. So in my time, I picked up a couple things or two, and I was always the head trader of some big funds. And we focus on levels, trends, momentum. We don't really worry about dumb things like Fibonacci or Elliott wave. Yeah, I said it. I mean, come on, Elliott wave, Fibonacci. That's science fiction. If you want science fiction, just watch the X-Files or watch Twilight Zone. Let's talk about important levels. A level that was resistance back here. This is December of 21. Okay, this is 18 months ago when the market peaked. Where did the tech sector find resistance? Right at 177. Why would this happen? There's people that bought back here who regret doing so. They tell themselves, man, if this ever gets back to my price, I'm going to bail out at break even. So you have remorseful buyers placing sell orders. If you have enough, the level that was resistance becomes resistance again. But then sometimes we break through and the level that was resistance becomes support. Why does that happen? Seller's remorse. There's people who sold to the market goes higher, and a lot of these investors sell themselves. Man, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I get them for the same price I bought them at. So if you have enough remorseful sellers placing buy orders, the level that was resistance becomes support. But now it looks like this support is going to break. I mean, today was a pretty ugly day. I mean, it was only a small day, but sometimes a market doesn't have to move a lot for it to be important. What's an important day? A day where an important support level breaks, a trend reverses. This is some negative action. And if you follow me, and hopefully you do, and hopefully you'll tell your friends or colleagues to start following us, because there's so much garbage out there in terms of tech stuff. I mean, market stuff and technical analysis that it's just a waste of time, and it's just I don't know. Just check us out. Come hang out with us for a while. Join the Stock Market Jobber community. This is a negative day, big reversal here. All right, so financials look weak. They're reversing. Tech looks like it's breaking the support level. Look at where we closed. It's the lowest level in about a month. Healthcare, too, is the second biggest sector, and this looks weak as well. I mean, look at this. This got to resistance, and it was overbought. Overbought markets that get to resistance tend to sell off. Tell yourself that. Like, read it like a mantra. Like, read it 100 times before you go to bed tonight. All right. This is some really nasty action. You know, it wasn't that big of a move. It was only 75 basis points, but it tells us that things look like they could be failing. So, three biggest sectors in the market. The S&P is 11 sectors. Biggest sectors are tech, healthcare, financials. They all look weak. The market looks very precarious. I think there's a good chance we're going to go lower. And then, you know, if you're not an options trader at Stock Market Jobber, we talk a lot about ways to invest in the market where you can make money when the market is going down. Some people don't think that's possible unless they're a futures trader or an options trader, but it doesn't need to be. There are things that we call inverse ETFs. Now, look at this. S&P was down 66 basis points today. All right, say you're kind of a conservative investor and you think the market's going to go lower. You could buy this ETF, which is designed to go in the opposite way of the S&P 500. So you don't need to be an options trader. You don't need to be a futures trader. You could just buy a regular ETF, just like you buy a regular stock. Look, market was down 66 basis points. This was up 66 basis points. If you get more aggressive, you could look at things like this. This is an ETF that's designed to move way more than the reversal. It's designed to move 3 times as much. It uses leverage. S&P goes down 66 basis points. What is this? Up 2.1%. So if the S&P goes down another 2%, and I think it's going to, this is going to go up by about 6%. So anyway, everybody, thank you so much. You know, people always tell me, or they ask me, they're like, dude, you know, like you make these great market calls. You know, how do you do it? Blah, blah, blah. You know what? I'm not a genius. I have no secret system. When you follow the market every day, and that's what we do at Stock Market Jobber, you just see stuff. You see it happening. Okay. The market talks to you. How does the market talk to you? It talks to you by how it acts when it gets to these important levels. So I'm no genius. I don't have a secret system, but I've been doing this for a long time and I know what to look at. And if you become a member of our community, I think you're going to as well. Most people overthink the markets. You know, it's not rocket science, it's just understanding psychology. And, you know, those of you who've been following us for a month or two now, it's like, you know, I mean, things work out just as we thought they would. And we're not predicting the future, we're just following the markets. So, excuse me. So today we got the 3 biggest sectors in the market showing negative action. Guess what? That's probably a good sign that the market's going to go lower. All right, everybody. Thank you so much for tuning in. Make sure you come back tomorrow, and I will see you then. Thank you.